usually when you think about buying a home, there's this comforting, almost primal sense of absolute possession. You
Yeah.
finally get the keys, you stand in the empty living room, and you just think, hey, these are my walls, this is my roof, I own this piece of the earth.
Right, yeah.
Yeah.
It's the ultimate real estate dream, right? You're the king or queen of your castle, and that physical structure around you, it represents your financial security.
Exactly. But when you start looking at the Finnish housing market, that solid ground just completely shifts beneath your feet. You touch those walls and realize you don't actually own them. The roof over your head isn't yours either.
Yeah, it's a totally different world. You're stepping into a system where your ownership is, well, surprisingly abstract. And the financial implications of that can be completely baffling to anyone who hasn't grown up in it.
Which is exactly why we're doing this deep dive today. We've been poring over this massive stack of sources to figure out what is actually happening in the 2026 Finnish housing market. We're talking forecasts from Danske Bank, Nord, LKV, sijutusasunnot.com, plus some heavy legislative reports from the Ministry of Justice.
Oh, and that really fascinating energy efficiency study from Metropolia University, too.
Right, so the mission today is to synthesize all of this. Because whether you're an international investor hunting for rental yields or an expat just trying to understand your rights and, trying to figure out why your neighbors can suddenly hand you a 50,000 euro plumbing bill,
Yeah.
you need to know how this works.
Yeah, you really do, because 2026 happens to be a super fascinating time to decode it. The legal landscape, the economics, the demographics, they're all colliding right now in ways that just fundamentally change how you have to approach buying property in Finland.
Okay, let's unpack this. Because the sheer timing of jumping into the market right now is presenting a bit of a puzzle. Real estate brokers are actively throwing around phrases like a buyer's dream year for 2026.
Oh, of course they are.
Right. My immediate instinct is to check my wallet because brokers always say it's a good time to buy. So, I want to know, are we just looking at real estate marketing hype designed to move stagnant inventory?
Well, skepticism is definitely the right default setting there. But if you strip away the broker rhetoric and look strictly at the macroeconomic forecasts, there actually is real substance behind the claim.
Okay.
We're looking at a market that is still actively recovering from a rather severe dip after that crazy peak we saw back in 2022. During that peak, there was a lot of speculative air inflating prices. People were buying practically anything with four wall.
Yeah, the bidding wars were insane back then.
Exactly. But
Yeah.
that air has been completely let out. What makes 2026 stand out is that the active number of buyers actually remains surprisingly low.
So if there are fewer people showing up to the open houses, the power dynamic fundamentally shifts. You're not being rushed into those frantic, blind bidding wars where you have to, make a life-altering financial decision in 20 minutes.
No, not at all. You actually have the luxury of time now to inspect the financials, negotiate hard on the asking price, and just make a rational choice.
And you're doing so in a newly stabilized economic climate, right? Because the forecasts are predicting a very moderate, realistic rise in value, not another sudden bubble. Danske Bank is predicting 0.8% growth for 2026.
Yeah, and climbing to 2.5% in 2027. And other major banks are hovering around a 1.5% prediction for this year. And this stability is almost entirely driven by the fact that interest rates have finally hit a plateau.
Yeah, the sources mentioned the 12-month Euribor stabilizing around 2.2% as of late 2025. And for anyone unfamiliar with how Finnish mortgages typically work, they aren't usually these 30-year fixed rates you see in places like the U.S.
No, they're almost always directly tied to European benchmark rates like the Euribor.
Right. So when that rate goes on a roller coaster, your monthly mortgage payment goes on a roller coaster. But the European Central Bank's rates are now expected to hover around 2% straight through 2027, which means you can actually model your monthly cash flow with a high degree of certainty.
And that predictability is crucial, especially because the actual market strategy you employ depends heavily on geography. The data shows this massive widening divide in Finland between what are known as growth centers and smaller regional towns.
Yeah, I saw that almost half of Finland's entire housing stock is now concentrated in major metropolization areas. So places like Helsinki, Tampere, and Turku.
Exactly. And the strategy in those growth centers seems to be all about long-term capital appreciation. Entry prices in these cities have dropped significantly from their 2022 highs.
So you're basically getting in at a discount in areas where the population is steadily growing. The demand to live in Helsinki or Tampere simply isn't going away.
Right. But then you look at the smaller towns, and the math changes completely. The purchase prices in rural areas or declining industrial towns are incredibly low.
Huh.
Investors can walk in, buy an apartment for a fraction of a Helsinki price, and secure immediate positive cash flow and high rental yields right out of the gate. We're talking gross yields of maybe 3 to 5% or more.
The catch there is demographic risk, though, right?
Oh, absolutely. Huge demographic risk. Small towns offer incredible cash flow on paper, but their populations are rapidly aging and shrinking. So your return on investment relies entirely on keeping a tenant in that apartment paying the monthly rent.
Because the underlying property is certainly not going to double in value over the next decade.
Exactly. It might even lose value.
So investing in growth centers right now is essentially like buying a blue-chip stock on a temporary dip. You feel safe about the long-term trajectory. While the small towns are like high-yield dividend stocks with a noticeably riskier long-term outlook, you just have to hope the dividend keeps paying out.
That's a perfect analogy. With those high-yield towns, you're playing a much shorter game. You need that cash flow to recoup your investment before the building itself potentially outlives its economic usefulness.
And that economic usefulness brings up the most critical part of this entire deep dive. It doesn't matter if you lock in a great interest rate or find the perfect geographical strategy if you don't understand the fundamental nature of what you're actually buying.
The Finnish anomaly.
Yes, the asunto-osakeyhtiö system, which translates to the housing company system. This is where the concept of homeownership takes a sharp turn away from international norms.
It really does. When you buy an apartment in Finland, you are not buying real estate.
This requires a complete mental reboot for a lot of people.
Oh, yeah. You are buying shares in a mutual limited liability company. And those specific shares happen to grant you the exclusive legal right to possess and use a specific apartment within a building.
So the housing company itself, which is co-owned by me and all my neighbors, is the actual legal entity that owns the physical building, the land it sits on, and the structural walls. I own shares. The company owns the concrete.
You've got it. That's exactly how it works.
Hang on, though. If the company owns the walls, the concrete, and the plumbing, does that mean my own bathroom renovation isn't actually entirely my business? Like, if I want to tear up a floor or install a fancy luxury rainfall shower in the apartment I theoretically own, who ensures I don't accidentally flood the entire building?
The housing company does, and they have strict legal mechanisms to enforce it. The renovation guides we analyzed map out this division of responsibility very clearly.
Okay, lay it on me.
So the housing company is responsible for the building structures, the insulation, the windows, and the basic utility system, so heating, electrical, and plumbing. You, the shareholder, are solely responsible for the interior surfaces. Paint on the walls, the laminate on the floor, the cabinets in the kitchen.
So if I just want to repaint my bedroom or change the wallpaper, I can do whatever I want.
Pretty much, yeah. But the second you touch anything that interacts with the building's core structures, the rules change drastically. You have a broad legal right to remodel your apartment, but you are required by law to submit a detailed written notification to the housing company before you begin any significant work.
Wow.
And if you're renovating a bathroom, the company has a legal duty to supervise that project to protect the structural integrity of the building. And the law states that the person initiating the work you must pay for that outside supervision.
I'm essentially a highly privileged tenant of a company I partly own, paying a third-party inspector to watch my contractors work in my own home.
I mean, when you put it like that, yes.
Yeah.
But the legal rationale becomes obvious when you consider the stakes. A bad waterproofing job by your contractor doesn't just ruin your new bathroom tiles. It sends water seeping into the concrete floor, destroying the ceiling of the neighbor below you, and rotting the company's property.
Right, which hurts everyone's investment. And the legal precedents enforcing this division are surprisingly rigid. We looked at a famous Supreme Court case from 2003 outlined in the Ministry of Justice reports.
Oh, the luxury floor case. What's fascinating here is how strictly they applied the law.
Yeah, so a shareholder had installed an unusually expensive, non-standard luxury floor in their apartment. Sometime later, a pipe burst. And because the pipes belonged to the housing company, the company was responsible for fixing the leak.
Right. But to fix the leak, the company had no choice but to tear up the shareholder's expensive floor. And here is where the division of responsibility shines. When it came time to put the apartment back together, the company was only legally required to repair the floor back to a standard basic level.
So they didn't have to replace the luxury material.
Nope. The housing company is not an insurance policy for your lavish interior design. If you want your imported marble tiles put back, you pay the difference out of your own pocket. The financial risk of luxury upgrades falls entirely on the individual shareholder.
That is wild. And since the company owns the building, the immense costs to maintain that aging physical structure are shared collectively among all the shareholders. This shared financial ecosystem leads directly to the single biggest risk for anyone buying in Finland. Surprise? Multi-million euro renovation bills.
Oh, the dreaded putkermonti.
Yes, the traditional Finnish pipe renovation.
This is where thorough due diligence elevates from a good idea to a matter of absolute financial survival. The Finnish building stock, much of which was rapidly built in the 1970s and 80s, is aging very quickly. We're looking at studies estimating a massive technical repair need of 7.79 billion euros annually between 2022 and 2050.
Billion with a B. And these aren't small aesthetic tweaks. We're talking about gutting the plumbing of the entire building, or massive roof replacements, or facade overhauls. These are existential repairs that can suddenly add 50,000 to 100,000 euros of debt to your personal share of the company.
Exactly. And the daily running costs are spiraling as well. The sources point to the KYKI index, which measures real estate maintenance costs, things like district heating, electricity, waste management, snow removal.
Right.
That index has surged between 60 and 84% since 2009. Meanwhile, household disposable income only rose around 47 to 52% over that same period.
The math for the average resident is just getting incredibly tight. Yeah. Heating costs go up, trash collection goes up, but salaries aren't keeping pace. So how does a buyer figure out if they're stepping into a well-managed company or a ticking financial time bomb?
You have to look intensely at the vastike. That's the monthly maintenance fee you pay to the company based on the square meters of your apartment.
And what's considered a normal amount right now?
A healthy fee right now generally sits between 3.5 to 4.8 euros per square meter. If you see a fee that is wildly fluctuating from year to year, or if it's alarmingly low, you have to ask why. Are they artificially keeping the fee low by ignoring critical maintenance?
That's a huge red flag.
Oh, absolutely. And even worse, if you look at the financials and see the company is taking on bank debt just to pay its daily running costs, you should walk away immediately.
Yeah. Run, don't walk. But it isn't entirely a landscape of doom and gloom, provided the housing company board is proactive. I want to bring up that fascinating energy efficiency study from Metropolia University in our stack.
Yeah, that was a great case study.
They looked at a classic 1980s terraced house in Viti. These older buildings are notorious for leaking heat, but by undertaking a series of targeted upgrades, renewing the old windows and doors, adding modern air source heat pumps, and increasing the roof insulation, they fundamentally changed the thermal envelope of the building.
They cut the building's total energy needs by a staggering 23%.
And in the Finnish system, cutting the building's energy needs by 23% translates directly into lowering the vastike for every single shareholder.
Exactly. The study also modeled the addition of solar panels, demonstrating they would pay for themselves in 10 to 12 years. So a forward-thinking housing company that actively invests in green upgrades is creating a massive financial shield for its shareholders against those rising KYKI maintenance costs.
That sounds great for a healthy building in a growing city. But what happens to the buildings in those declining high-yield small towns we talked about earlier? What happens when a 1970s concrete block in a shrinking municipality suddenly needs a 2 million euro pipe renovation?
Well, then you hit the nightmare scenario, which the government is actively trying to address with the new 2026 legislative proposals. In areas with shrinking populations, the market value of the apartments drops so low that the total cost of the plumbing renovation often exceeds the total value of the building.
Yikes. So what does the bank do?
When the housing company goes to the bank to ask for a loan to fix the pipes, the bank simply says no. The collateral just isn't there.
Here's where it gets really interesting and honestly a bit terrifying. You're telling me that I could buy an apartment, diligently pay my personal mortgage every single month without fail, and still lose my home because my neighbors can't afford a massive repair bill and the bank refuses to lend the housing company any money?
That is the stark, unavoidable reality of the system. You are financially chained to the collective health of your neighbors and the underlying value of the local market. If the company cannot secure funding for vital structural repairs, the building becomes financially obsolete. It just begins to rot.
And the 2026 legal proposals are stepping in to deal with this exact grim reality. I read they're making it easier to place a hopeless housing company into liquidation, salva distilla, or bankruptcy.
Yes. The end game is to forcefully liquidate the company, tear down the dilapidated building, and sell the raw land just to cover whatever debts remain.
That completely reframes the entire process of going to an apartment viewing. Inspecting the company's long-term 10-year renovation plan, its cash reserves, and the competence of its board of directors is infinitely more important than admiring the fresh paint in the living room.
Absolutely. You are buying into a shared financial destiny.
Okay, let's pivot slightly because I want to talk about buying as a foreigner. For our expat listeners, the actual process of buying an apartment in Finland is surprisingly straightforward.
It is, yeah. Unlike buying a detached house with its own plot of land, which sometimes requires special permissions for non-EU buyers, buying shares in a housing company doesn't require any special permits.
Right. And the transfer tax is relatively low, around 1.5 to 2%.
Huh.
The real hurdle for foreigners seems to be getting the bank loan in the first place, right? The banks have pretty strict requirements if you don't have a long financial history in Finland.
That's usually the biggest bottleneck, yes. But once you're in, you're in. But living in that shared destiny requires strict governance. When you cram dozens of financially linked people into a single building, the rules of coexistence are paramount, especially when modern economic trends clash with traditional residential living.
You're talking about the short-term rental boom. Airbnb and similar platforms have turned residential apartments into high-turnover hotel rooms. The scale of this in Finland is massive. The sources show 696,000 platform nights in Rovaniemi in 2024, driven by the Lapland tourism boom, and 853,000 nights in Helsinki.
It brings incredible yields for investors, sure, but it also brings constant wear and tear, noise, and strangers wandering through the hallways of quiet residential buildings.
And the 2026 legislative updates have zeroed in on this friction. The new laws explicitly clarify that shareholders are strictly liable if they act negligently in choosing or instructing their short-term tenants.
Exactly. You can't just install a key lockbox, automate your bookings, and turn a blind eye to what happens inside the building. You must maintain active contact information for your guests. If an Airbnb guest throws a massive party and destroys the lobby or damages the sauna, the housing company needs to know exactly who to go after, and you as the shareholder are on the hook for facilitating that.
So what happens if a shareholder, or their long-term tenant for that matter, repeatedly refuses to follow the rules? If they're constantly disruptive or ignoring the board, the housing company isn't just a suggestion committee, right? It has serious legal teeth.
Oh, very serious teeth. The ultimate weapon a housing company has is a process called hallintonotto. It means taking over the possession of the apartment.
Wow. Taking it over completely.
Completely. If someone lives disruptively, intentionally damages the property, or fundamentally violates the company's rules, the board of directors can issue a formal legal warning. If the behavior continues, a general meeting of all the shareholders can vote to forcefully strip you of your right to use your apartment for up to 3 years.
A 3-year exile. So the housing company board is essentially a localized mini-government. It has taxation power through the monthly maintenance fees, and it literally has the power to banish you from your own home if you let your Airbnb guests throw too many wild parties.
The mechanics of it are fascinating. The company takes legal possession of your apartment, rents it out to a tenant of their own choosing, and uses that rental income to cover your unpaid maintenance fees or to repair the damages you caused. After the costs are covered and the 3 years are up, you finally get the possession back.
And the 2026 laws also bolster tenant protections in these extreme scenarios, right? Because if you're an investor and your apartment is taken over by the company because of unpaid fees, or if the entire housing company goes bankrupt like we discussed earlier, the rental agreement you have with your tenant is automatically terminated without a traditional notice, period.
Right, the tenant is just out. However, if you fail to adequately warn your tenant about the impending takeover or bankruptcy, you, the shareholder, are legally required to compensate the tenant for their moving costs.
That makes sense. So if you're an expat living next to a disruptive short-term rental, or an investor trying to manage a portfolio of properties from afar, you have to internalize that the housing company's collective rules always supersede your individual desires. You are participating in a highly regulated microdemocracy.
And the only way to survive in a microdemocracy is to actively participate. You have to read the board minutes, attend the annual general meetings, and actually understand what is being voted on, because those votes dictate your monthly costs and the underlying value of your investment.
So when we synthesize all these sources, the bank forecasts, the energy studies, the new laws, the picture of the 2026 Finnish housing market is one of cautious opportunity. The speculative frenzy is absolutely gone, interest rates are offering a predictable horizon, and you have the breathing room to hunt for strategic deals.
Whether that's chasing capital appreciation in a booming growth center like Tampere or chasing high-yield cash flow in a regional town.
But that opportunity only exists if you do the grueling due diligence required by the system. You have to look past the beautiful interior design and scrutinize the unglamorous mechanics of the building. You need to know the age of the pipes, the health of the roof, and whether the company is proactively investing in green energy or spiraling toward a multi-million-euro debt crisis.
Which leaves us with a final, broader implication to consider. We've talked a lot today about your rights and responsibilities as a shareholder, but consider this. As the Finnish population continues to concentrate heavily into just a few major cities, leaving smaller towns behind, the legal mechanisms to demolish and liquidate bankrupt housing companies are being actively streamlined.
They're greasing the wheels for buildings to be torn down when the math stops working.
Precisely. So as you look 5, 10, or 20 years down the line, you have to ask yourself, will the true lasting value of your real estate investment actually be the beautiful, newly renovated apartment you live in? Or will the true value simply be the geographic patch of dirt that your collective building happens to be sitting on?
That is a brilliant and slightly unsettling reality check to end on. It completely shifts the perspective from interior surface values to raw, underlying land value and demographic survival. Thank you for joining us on this deep dive into the 2026 Finnish housing market. We highly encourage you to go grab your own housing company's financial statements or the prospectus of the building you are thinking about buying into and read the fine print with fresh eyes.